Hello everybody and welcome to our next NAP. NAP stands for Nonprofit Auditor Points and I'm Irina Ryshkova, your nonprofit auditor. This video is designed just to help nonprofit community with some accounting questions and some accounting concepts that hopefully will make your accounting life easier. Okay, let's start. We continue series on revenue recognition. And in the last episode, I discussed a bigger picture, explaining that nonprofits are unique because they have two different type of revenue that falls into completely two different buckets and they governed by different standards. We were discussing that revenue recognition for the exchange transaction governed by 606, and for contributions, which are gifts, donations, bequests, grants, pledges, it's governed by 958. So today we're going to focus on exchange transaction, where we discussed that the entity that pays for the two nonprofits receives similar value in exchange. So again, it's a standard 606. Very often we call it earned revenue or exchange transaction. It operates very similar as for profit world. We do recognize that many nonprofits have various type of earned revenue. An exchange transactions happens when nonprofits provide goods or services and other party receives something in exchange in a similar value in return. Again, it's not a donation, it's not a gift. It is a transaction when if somebody pays tuition and receive education in exchange, that's exchange transaction. That's 606. If somebody buys a ticket into event and attends the event, it's exchange revenue. If nonprofits provide services under government contract and government pays for the services and the recipients of the services, the government itself, employees of the government, it's a government contract. It's a 606. If nonprofits sell merchandise, books, any program materials, it's exchange transactions, any program revenue. If nonprofit have a museum or game arcades and the kids and adults come and pay for the ticket to come in and attend a park event or play those games, it's a exchange transaction. So the key question is always the same. Is the payer, the person or entity that pays, receiving similar value in exchange? And if the answer is yes, it's a standard 606 or exchange transaction. And under that standard, revenue recognized when services are provided in exchange, service or goods. So as soon as exchange happens, then you recognize revenue. And as we discussed in the previous SNAP, this standard 606 is not specific for nonprofits. It's just a standard for every company out there, including nonprofits and profit organization. So in this sense, nonprofit operates like any other commercial entity. So when they have a contract with the customers receive the service and nonprofit recognize revenue. And nonprofits do have customers. So we sometimes call them members, but they can be, or participants, but they are customers if they exchange transactions. Just to understand the standard 606, how revenue gets recognized under 606 exchange transaction. So this is model, as I said, it's not specific for nonprofits and it follows 5 steps. If we want to be very technical, let's just describe those steps. But in technical terms, it could seems complicated, but it's easy. So in a sense, you recognize revenue, which you need to follow 5 steps. Identify the contract. For example, if it's a school that's run by nonprofit and participants or customers pay for classes, let's just say after school classes for fall semester. So that's a contract. Typically, school will give a contract to students that you have to pay $1,000 for after school program. That's going to be in full semester. So you have to identify that there is a contract between nonprofit and customer. Identify performance obligations. So meaning that in that contract, nonprofits have to deliver some specific services or goods. Identify transaction price. What is the price? For example, in fall semester, it's going to be 10 classes that cost $100 each. So we identify the price for revenue recognition, because if we need to recognize revenue in the middle of the quarter, we know that only half was delivered out of $1,000. And then we need to allocate the price to performance obligation. Like I said, for example, organization need to recognize revenue in the middle of the fall quarter, and only half of the performances classes were delivered. So if a student paid the full $1,000, it's not $1,000 revenue, it's only $500, because that's how much service nonprofit delivered. And the step number 5, nonprofit need to recognize revenue when performance obligation is satisfied. Again, a lot of time in school tuition, you pay tuition ahead of the school period. And when customers, participants pay before the service is delivered, meaning obligations have not been satisfied by nonprofit. So this cash that nonprofit received would not be recognized revenue. It's called deferred revenue, which is liability. So under the standard 6 of 6, we need to go over each step, 5 steps, in order to recognize revenue. Contract, performance obligations, price, transaction price per item, allocate price to performance obligations, and recognize revenue when performance obligation is satisfied, not when cash received. Let's make it less abstract and look at an example, more specific example. Suppose your nonprofit runs a training program and charges $500 per participant, and you have a contract, even if it's just registration agreement. You don't have to have like a formal contract. You probably have some promotional material, you do the training and registration agreement information. So that's $500 per participant. Your performance obligation will be delivered at the training. So as soon as the training done, performance is done. Transaction price, it's $500, and you recognize revenue when you deliver the training. Does not matter if the participant paid you or not, because it's not cash revenue recognition. So if the recipient did not pay you, you will record receivable, but revenue would be recognized as soon as training was done. If somebody prepays in December for training that happened in January, meaning that in December you did not meet your obligations, right? You did not deliver the training. Performance obligation was not satisfied in December because training happened in January. So you do not recognize revenue in December just because you got money. Again, if you got money in December for training that took place in January, then you recognize deferred revenues or unearned revenue. That's liability. And in January, after the training was done, you move in deferred revenue to revenue, from liability to revenue. So under the standard 606, one more time, you recognize revenue when the service is provided, not when the cash received. Cash is irrelevant here. Again, cash received does not mean anything. It could be deferred revenue, could be revenue. Now let's talk about why earned revenue can actually be a healthy thing for a lot of nonprofits. Earned revenue often brings sustainability. Why? Because in this type of revenue, nonprofit relies on their own ability to make an earnings, not relying on donors too much. So they really creates independence from donor cycles. It allows nonprofit to build their program that generates predictable income. So you have ability to budget better, and it also requires discipline. If a lot of nonprofits who supported by earned revenue based standard 606, they compete in a regular environment with for-profit organizations. It means that they build sustainable program, they have valuable services, and nonprofits that supported by earned revenue, they operate in exchange transactions. They need to deliver what they promised. They track their performance, they understand the pricing, they have to be competitive, they document the contracts clearly, they typically watch their expenses much more carefully because they know the bottom line need to be positive. They need to bring more money than the expenses. So it builds a sustainable, healthy nonprofit organization. That's the difference between contribution, where the focus of the donor on the donor intent. So when the nonprofit supported by contributions primarily in donors, they concentrate more to what was the donor intent, what donor wants to do, versus on earned revenue, nonprofits rely really on their program model and build sustainable performance. Now, let's talk about government agreements. We talked very briefly in the previous snap about government agreements, and we said that a lot of nonprofits supported by government on various levels. It can be city, county, state, and federal funds. So various type of city government various type of government does and do support a lot of nonprofit organizations. But we cannot just knowing that money came from government assume it was a grant or contribution. It's not always true. Government hires a lot of contractors, including nonprofit organizations. And when the nonprofit operates as a contractor, where nonprofit delivers services to a government and government recipient of the services, this is exchange transaction. So if the government agency is essentially hiring the nonprofit to deliver specific services for government, for the city, county, that it may be exchange transaction and it needs to be recognized under 606, those 5 steps. Therefore, again, we're going back to the fact that substance of the agreement really critical. Regardless, what is it, every time when nonprofit receive an agreement, especially from government or any sources, the first we need to understand substance. Is it exchange transaction, contract, or it's a contribution? And we need to look in the substance. So therefore, reading agreements carefully is very important. Another very common area of exchange transaction where it can be complicated, it's a membership. there's different memberships exists, and some memberships are primarily contribution based. So a lot of time members become part of the nonprofit, and they just give donations, and they receive very minimal things in exchange, maybe t-shirt or some merchandise with the name or recognition of the name in the annual brochure. So that's minimum recognition. There is no same value in exchange. So those are contributions. But other memberships provide significant tangible benefit to members, such as services, access to their database, various discounts, classes to take, and if the members pay for the membership in order to receive these values in exchange, that's earned revenue. So if the members receive meaningful value, at least part of the membership, then it may be treated as exchange transaction as a revenue recognition. So membership is tricky. We need to understand what members are paying for. Sometimes part of the membership could be paying for services, and some part it's really just a contribution. So earned revenue affects more than just accounting. It can affect how nonprofit will strategize their future performances, how they assess their risk, market risk of their customers, financial forecasting, budgeting, right? Operational planning. If a significant portion of your revenue is exchange-based, your organization must consistently deliver services to generate revenue. There is plus and minuses to it. If your earned revenue is declined, you may not be, you might have a fundraising problem. Or it might not be fundraising problem. It might be demand or pricing issue, right? So if your customers stopped using your services, maybe it's a quality of the services that you provide, or maybe pricing is not reasonable, or maybe demand for this type of services have changed. So then your nonprofit might actually think what your customers might need. Maybe you need to change the type of the services, or maybe just reorganize them slightly. From the auditor standpoint, exchange revenue is also, we pay a lot of attention, and we look at the contracts, timing of revenue recognition, meaning when obligation was met. So if we see a large number in deferred revenue, meaning unearned revenue, we need to understand why customers prepay you for the services ahead of time. So we also need to understand obligation performances, what nonprofit is actually promising to deliver to customers. So 606 sounds very technical, but underlying concept for 606 exchange transaction is very simple. Revenue is recognized when nonprofit deliver services or goods that were promised, right? So that's very simple. Performance obligation is met, revenue is recognized. Not when you receive the money, not when it's, when you sign the contract. No, it's only when obligation is met, nonprofit delivered services. Signing the contract means nothing in this case. So in our next episode, we're going to shift gears and go back to other side of framework, to contributions under 958. So this, we were talking an exchange transaction in this NAP under 606. In the next NAP, we're gonna look in the second bucket, which is contributions. So now, key takeaway from today's NAP. If your nonprofit provides goods or services and receive similar value in exchange in return, You're dealing with exchange transactions revenue under 606. And the timing of revenue recognition depends when the services are delivered by nonprofit, not when the cash received and not when the contract was signed. Hopefully that was useful. Hopefully you guys will continue listen to my next nap, and hopefully you enjoying it. Thank you so much and have a wonderful day.